Hello traders, welcome back to the Forex Geek where we dive deep into the tool that can help you make smarter trading decisions. And in today's video, we are going to be talking about the ICT Asian Range Strategy, a powerful approach that can significantly enhance your Forex trading results. This strategy focuses on leveraging price movements during Asian section. This identify high probability trade setup. You will learn how to spot key support and resistance levels on the chart. You will also learn how to recognize liquidity sweeps and align your trade with your daily bias. By the end of this video, you will have a comprehensive understanding of how to implement this strategy to your trading routine, potentially improving your accuracy and profitability. So stay tuned as we break down each component of the ICT Asian Range Strategy, and we'll show you how to apply this effectively in the real market condition. So we start by understanding what is the ICT Asian Range Strategy. And the Asian Range Strategy is a trading method that focuses specifically on price movement. It focuses specifically on price movement during the Asian section. This is what we are talking about. It focuses on the Asian movement of price action during Asian movement. Okay, this strategy does not rely on complicated indicators or complex algorithm. Instead, it emphasizes your ability as a trader to carefully observe and interpret price action within the clear defined time frame. That is, during the Asian section, the market often trade within a relatively tight range, establishing clear high and low points. These two extremes, the high and low points reached during the session, form what they call the Asian range. By marking out these levels on your chart, you create important reference points that would help you guide during your trading decision. As you can see from my chart, I have marked out a few Asian ranges. These are typically areas when Asian section started. As you can see, during my own time, Asian starts from exactly 12 midnight till 5:45 a.m. in the morning. So marking the most recent Asian section, I'll mark from the beginning of 12 midnight, 12 midnight in my time. 12 midnight from my time is this. From the 12 midnight, I will mark out both the highest point and the lowest point that formed during the Asian section. So the lowest point should be this during my Asian section. The lowest point was around 3 a.m. and it ended around 5:45 in the morning. So this is when my Asian session ended at this area. So I'm just marking out the highs and lows so that we can know how we can capitalize on this market. There are some indicators that can help you mark out the Asian highs and lows for a better and easier way to identify them. Now let's go to why are these Asian range important? The Asian range provide valuable clues about potential market direction for the rest of the days. Price often moves beyond the range subsequently to sweep liquidity, meaning it moves above or below the established level to sweep liquidity or stop loss or pending orders established around that area. This liquidity sweep trap retail traders who enter premature trades or premature breakout, triggering their entries and breakouts and reverse in the other direction and breaks out. This is an example of what I'm talking about. If we are to enter, if This is a particular Asian range that ended by this time. If we extend our line, we can see by this time in the price, by this time around 7 a.m. 8 o'clock, some traders would have decided to want to take a breakout to the downside by this area, setting their sell limit after the breakout around this area. When they set their sell limit or their sell stop, when price breaks out to the downside, they would want to catch this trend, but price reversed on them. As we are the smart traders that have a strategy, once we see this reversal, this is when we would want to capitalize on the market. So this is exactly what the Asian range is all about, faking traders in one direction and moving to the other direction. Understanding this concept will help you anticipate market direction more accurately. By observing how price behave around these levels, you will gain insight into institutional trading levels and overall market sentiment. This makes the ICT Asian Range Strategy particularly useful for predicting volatility and identifying high probability trade setup based on clear market structure shifts. In essence, mastering this strategy equips you with a straightforward yet highly effective approach to reading the market behaviors in the early trading day, improving both your timing and accuracy in your forex trading. Now let's see how we can trade using the Asian range strategy. The trading using the Asian range strategy involves a clear step-by-step approach. First of all, you will need to identify your Asian range by marking out the highest and the lowest point in your Asian range, and this is what I have marked out. This was today's date, this was the yesterday's, the previous Asian range, this was day before, and the case may be. You mark this out by typically marking from your midnight to your, for New York, you mark from 7 p.m. midnight New York time to the beginning of your New York day. This is of Asian range is typically between 7 p.m. and midnight New York time. This is exactly what the Asian range timing is. So if you are in the US or you are in any part of the world, you just typically get a corresponding time with the New York time. This is going to start from the 7 p.m. New York time to the midnight of the New York time. Do not forget, these two price points becomes your key reference levels for trading, for your trading day. Once you have established your range, your next step is to monitor price movement closely as price trades moves in the direction. You monitor trading moves within the London and the New York section around your Asian range side. So this is for the current day. You are specifically looking for price to break outside of a range, either above or below, because this movement signals important market shift and liquidity sweep. In a bullish market condition, you will watch price first, and you would expect price to move below the Asian low like it did in this area, move below the Asian low and either above or below, because this movement signal important shift known as liquidity sweep. While it's in a bullish market, it moves below the Asian low, while in a downward market, it moves above before moving in the intended direction. Let's look for an example of a selling opportunity. Selling opportunity, you would notice the market will first of all move in the opposite direction before it moves to the other direction. Let's get a good opportunity for a selling trade. And as we can see from the chart, we can see that price first came to this area on the chart, this Asian high, swept the high before trading downward to the down direction. So this is typically what the trading range, when used properly, would establish for us. Remember, once price sweep liquidity below this level and then quickly reverse upward, you have a potential buying opportunity. Conversely, when it sweeps higher and reverse to the downside, you have a selling opportunity. So let's see how we can enter a buy opportunity. We enter a buy opportunity the moment we see a sweep below the Asian low. When other traders are trying to take a sell position at this area, you, because of you know about your Asian range, your Asian low and high, you are looking to take a confirmed long position. You can enter your long position above the Asian high or your short position when it crosses the low. So if I'm to enter this buy position, once it swept below, I would want to enter at the high when it breaks above the high. Remember, your stop loss is important. You have to put your stop loss just below the previous low. When you put it below the previous low, you can set it 10 to 5 to 15 pips below that low. We have to aim for a target of at least 1:2. 1:2, that's twice your stop loss. Whatever you are risking on your stop loss, you should aim for at least twice that of that. In both buying and selling scenarios, always confirm your entry by observing a shift in market structure. There should always be a shift in market structure, and as we can see for this buy trade, there was a shift in market structure because market created a lower low, then it broke this structure at this area. It broke this structure at this area, signifying when it broke this structure, signifying higher prices, and price decided to make a higher low at this area. When price made a higher low, this was an area that aligned with our Asian low, our Asian range strategy, which included a sweep below before moving in the intended direction. This confirmation helps you to avoid fake signals and improve your trading accuracy. So you enter your trade once price has swept and has moved in the opposite direction. You enter your trade. By following these clear steps, identifying your range, observing liquidity sweep, confirming entries and market shifts, you are managing your risks. You will be able to effectively apply your ICT Asian range strategy in your daily trading routine. Now let's look for another example. We can see exactly how the Asian range have marked out price more often or not sweeps one side and move to the other area. Let's see if we can get a bearish scenario to explain the example. These are areas in charts that has been marked out. So marking out my Asian range from this area, remember my Asian range would be from 12 midnight, this is 12 midnight, to be from 12 midnight to 8 to 5:45 in the morning. This will be my Asian range, and as we can see, the highest point during the Asian was this high, while the lowest point during the Asian range was this point. This was the lowest point that formed during the Asian low, during the Asian section, and remember it closed exactly by 5:45. Then when our trading day resumed, I would notice that price at this point, the London session swept the high. The moment price swept the high, this indicates that sellers are coming in. Remember that some traders will think that market wants to continue in the intended direction and take a buy trade, and they will be stopped out, because if you decide to take a buy trade after price breaks out of the high, remember your stop loss will be below your resistance area. So when you take a buy trade at this area, you will be stopped out because you do not have the idea of the Asian range liquidity sweep. But Because you guys now have an idea about the sweep, you would always be expecting a sweep before the market move in the intended direction. So when market sweeps, you can be able to capitalize on the trade by taking a sell trade instead of taking a buy trade. You take a sell trade, you put your stop loss just above, and you ride the trend to the downside. Alright traders, we have come to the end of this video. If you found this video interesting and helpful, do engage with us in the comments below. We want to hear about your experiences. Do not forget to like, share and subscribe, and turn on your notification bell so that you wouldn't miss out on more trading tips and strategies. Thank you for watching, and I will see you in the next video.